Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. It's the Monday after the week when the Fed went 50. There was at least some uncertainty about the decision before 2 p.m. last Wednesday. The warp page on the terminal, World Interest Rate Probability, had to have been summoned countless times by street fighters seeking guidance from Mr. Market. It's said that Powell himself became so fixated on the betting odds and so familiar with this Bloomberg mnemonic that he created his own cheat code. For Powell, warp became what I really prefer. And that, my friends, was 50 basis points. Never mind that inflation's above target, or that IG credit spreads were in the 5th percentile, or that financial conditions were already very easy. For JP, the old risk management adage is not hedge when you can, not when you have to, but rather ease when you can, not when you have to. 50 in the books and presumably more to come. The market, until presented with further evidence on economic weakness, was left to do what it must, react to the Fed's reaction. Gold, Bitcoin, the S&P up, vol lower. Nothing really out of bounds. Warp, what I really prefer, Powell was heard muttering with satisfaction to himself, marking his own fresh VXX shorts to the market outcome he created, contemplating the beauty of positive carry. Come on. I'm just kidding. Sort of. But let's take stock of the post-Fed prices we see and what they mean. Sit back, please, for 15 minutes and 2,000 words, and maybe, just maybe, I'll have given you a nugget or two of useful guidance. And if not, let's seek out at least one chuckle, a chortle, a giggle, a tee-hee, in the words of George Costanza. Let's start with some commentary on the S&P 5630 strike September 18th straddle. Expiring on Fed Day, this combination of put and call options had very unique risk characteristics over the course of the day, with distinct behavior from the 9:30 a.m. open to the 2 p.m. announcement versus after the decision. At this point, we are all very familiar with 0 DTE, 0 days to expiration options. These ultra short-dated hits of dopamine come and go in the blink of an eye. They have all kinds of gamma, and the Greeks come right at you. The morning of Fed Day, that Sept 18th, 5630 put and call combo was 0 DTE. On a normal, non-Fed day, this straddle would need a quick and decisive move in the S&P in the morning, either up or down, to compensate for the substantial time decay that is the flip side of the intense gamma. Without a big enough move, the options theta would undermine the fleeting option premium. The gamma and theta characteristics of 0 DTE are attached at the hip. But the 0 days to expiration straddle on Fed day was no normal 0 DTE. We might call this particular straddle 0 TTD. That is 0 theta to decision. You do know I like a good acronym. 0 theta to decision. Allow me to explain by way of my 5 C's framework for explaining the pricing of vol. The 5 C's: carry, credit, calendar, capital, and concern. I've explored this in detail in past podcasts in order to account for the factors that play an important role in explaining how the market prices implied volatility, both cross-sectionally and through time. The calendar component captures the manner in which known date-certain catalysts for asset price movement are reflected in option prices. Traders know, for example, that the 4 earnings dates for a company each year sponsor volatility that is roughly 3 to 6 times higher than the volatility of the remaining 248 non-earnings days. If you like more money than less, sort of a basic premise in economics and finance, you'll pay more for the option that includes the earnings date and the extra vol that comes with it. Higher option prices and higher implied vols reflect this greater demand. Our 0 TTD straddle is a unique example of the calendar component of the 5 C's. The Fed decision isn't just a day on the calendar. It's a specific time of day on that date. It's not like non-farm payrolls, which comes out before the market opens. It's not like NVDA earnings, which come out after the market closes. Powell and his teammates at the Fed have decided they want to give us the goods during the trading day. So we need to think about the 9:30 to 4 trading session on Fed Day as two, and in a way, three subsessions. Let me explain. You may recall the 1980s song, Ain't Nothing Going On But the Rent. For Fed days, it's Ain't Nothing Going On pre-event. With this in mind, as trading came to a near standstill in typical fashion ahead of a monetary policy decision last week, I took some time to map out the behavior of the 0 DTE and 0 TTD 5630 strike straddle on Wednesday. I posted these charts on Twitter. What did we see? This straddle had literally zero theta to decision. From 9:30 a.m. to 2 p.m., the price of the straddle had minimal movement and basically suffered not a cent of time decay. Fascinating. 5 of the 6.5 hours of the day came and went, and this theta-intensive straddle held all of its time value. When time passes and the underlying asset doesn't move in price and the straddle holds its value, only one thing can be happening, and that is a steady increase in implied vol. This offsets the theta that would normally be draining the option of its time premium. The straddle seller of the 0 TTD option reminds me of the Hamptons house owner who wants $100,000 for the summer, or $100,000 for the entire year. September to May don't matter much to the manor lords, who most certainly won't be seen at Nick and Tony's during the winter. The 5630 straddle lost almost no value from 9:30 to 2 p.m. From 2 p.m. to 4 p.m. is a very different story. First, of course, at 2, we learned the decision to go 50. The market raced higher, at one point quickly up 50 handles. The problem, however, for the straddle owner is that at least one part of the event uncertainty, the decision itself, was now behind us. Implied vol began to quickly deflate for this straddle, now with just 2 hours to expiry and no longer supported by one component of the unknown. The impressive pop in the S&P faltered, and the straddle, which traded around 60 at 2 p.m., was at just 50 by 2:20, with the S&P up 24 on the day. But there was one more glimmer of hope and one source of risk premium left, the 2:30 p.m. press conference. Here, the market would ascribe value to the uncertain manner in which Powell might frame out the decision. It certainly happened before. Once 2:30 came around and JP gave us not much more, the 0 TTD straddle reverted back to its true colors of 0 DTE and was gobbled up by the theta monster. It would expire worth less than $10. All right, so we covered 0 DTE and its subvariant 0 TTD. It's now time we briefly recap the prices of risk that present themselves post-Fed and finish with another date on the market's calendar. I like to say that nothing bad in markets happens when realized vol is below 15. What I'm referring to is the manner in which volatility interacts with concurrent returns. There's nothing predictive here, but not really a surprise. When realized volatility is well behaved, markets do well. Can we take a moment and celebrate financial pundits' use of the word well-behaved? It's like these statistics are kids. We're often told that inflation expectations are well-behaved. And, by the way, break-evens are, indeed, well-behaved. Just hit up the ILBE page on Bloomberg. I do digress. Back to vol and returns. Since 1990, the S&P has spent 60% of the time realizing below 15 and 80% below 20 on a one-month basis. Returns are steady and positive in these buckets. With realized vol below 10, the average one-month return is 1.9%. The worst return is negative 5.1%. That's actually pretty amazing. The S&P lost 5% and didn't even manage to realize 10 vol in the process. Drip, drip, drip. Talk about a stealth drawdown. What about between 10 and 15 realized vol? The index spends just under a third of the time in this realized vol bucket and delivers an average return of 1.3%. The worst return is negative 9.6%. Returns do start to suffer above 20 realized vol. In the 20 to 25 bucket, the average one-month return is down 1.2%. Ouch. Of course, we can remember back to the bull market run-up to the internet crash 25 years ago. That was a high realized vol positive return regime. It did end badly, but there was a wave to ride, at least for a while. One aspect of this bucket we begin to see is negatively skewed return outcomes. The max return is 13.3%, but the minimum is negative 18.3%. To level set on this bucket and what it takes for the market to realize between 20 and 25 vol, we are talking about roughly 1.25 to 1.5% a day in daily moves. At today's S&P levels, that's 60 to 80 handles, not a small number. Of course, the bulk of the heavy lifting is going to be done by a few very errant returns when the S&P falls 2 to 3%. The math of standard deviation, in which a day's return is squared, means that big moves do matter most. Back to mapping vol and returns. It's interesting to look at realized vol from 25 all the way to 50 and the relatively small amount of damage to returns. For example, in the 25 to 30 realized vol bucket, the average return is just negative 20 basis points. What's going on here? There's a double-edged sword with volatility. The asset price decline that comes with it certainly hurts returns, but it's often a pivot point. When selling pressure reaches a point of exhaustion, markets can bounce, sometimes sharply. In this bucket, the max loss is negative 18.5%, but the max gain is almost 15%. There's another factor at work during high levels of realized vol, and that's the Fed. The central bank pretends to look past market developments, but it's not merely a lender of last resort. The scars of contagion will never heal for the Fed, and it, perhaps rightly, has the view that when asset prices become unruly, it needs to assume its role in crowd control, lest a full-blown riot break out. Open-mouth operations ensue, or in the words of Kevin Bacon from Animal House, all is well. When realized vol is 50 plus, there is no escape for asset prices. The concurrent returns are devastatingly bad, negative 9.2%. This is what the Fed fears most. Scenarios like the GFC and COVID require a whack-a-mole approach to keeping the patient alive. Last point on this. While this is the most toxic bucket with respect to real-time returns, it's the most advantageous bucket for returns 6 to 12 months later. If you can be committing fresh capital during chaos, the odds are fantastic. You will be rewarded out a number of quarters. This is really the basis of my thoughts on how a well-designed hedging plan can empower buying in stressed markets. Okay, let's finish with some thoughts on our favorite index, the VIX, and its behavior post the Fed decision. Two topics of some regularity on this podcast over the past month or so have been the VIX beta and the VIX floor. By VIX beta, we simply mean the degree to which the VIX moves as a function of a given movement in the S&P. Clearly, the VIX is negatively correlated to the market. S&P down, VIX up, and vice versa. But to what degree? We can see that this beta comes and goes. From 2022 until well into 2024, movements in the VIX were pretty muted. But then came August 5th, a 65% surge in the VIX on a 3% sell-off, more than 20x. September 3rd was a mini version of this reinvigorated beta. The S&P fell by 2% and the VIX popped by 33%. Over the month leading into the Fed meeting, a given move in the S&P yielded a move in the VIX about 10 times that. So here's my observation as I see my word count is approaching 2,000. When the market decided that it, like Powell, really preferred 50 basis points and the S&P surged by 1.7% last Thursday, the VIX fell by just 10%. The recent 10x VIX beta would have predicted a 17% decline in the VIX. The more modest decline might be that sellers of insurance and the risk police, who keep a watchful eye on them, are saying they just can't provide convexity to the market at levels much lower than current ones. If we do hit a real rough patch for realized vol, carry is going to suffer, and that will put downward pressure on implied vol. I personally maintain that the U.S. election, that unfortunate, unpriceable source of uncertainty, is going to be a real headwind for equity index vol falling much from here. There's some shekels to be earned by selling October VIX put spreads. You won't get rich doing so, but you won't get poor either. All right, folks, that's going to be it for me. I'll be very interested to see how the market reacts to economic data over the next couple of weeks. I hope all goes well for you. Until next time.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.